Oh, hello and welcome to the weekend market update. Today is 20th of May, 2023. So you're looking at the weekly chart of S&P 500. S&P 500 was up 1.65% this week. You'll see that the S&P 500 has been consolidating underneath this 4200 for the last few weeks. And this week, it rebounded and it closed just below the 4200 level. It still remains within this bigger range of 3800 on the downside and 4200 on the upside. So that hasn't changed. If we look at the momentum indicators, you can see that the momentum indicators are still positive. RSI has been moving higher. The weekly RSI established a higher high. So this was the previous high around 58. So it closed at 58.63. If you look at the MACD is above the zero line and it continues to move higher. So on a weekly basis, both the price action and momentum indicators remain positive. Now, if we look at the smaller time frame just to see what we can observe. So last week, S&P 500, we talked about this big range that it was trading in. So it had been trading inside this range, and within this range, it also established a smaller range. But this week, it managed to break through both of those ranges. Initially, it broke through this level. This is 4150, and then it broke through the higher end of this, the bigger range, which is around 4185. What happened on Friday is that it traded above 4200 and then it has pulled back and it's now retesting this breakout level. So the question is whether this level is going to hold or not. The price acceptance above this level is very important. If it spends time above this level, that would provide confidence that this breakout is genuine. Let me show you what happened to NASDAQ so you can understand what I'm trying to say. So this, if you look at NASDAQ, so I'm just going to crunch it up a little bit so you can see. So NASDAQ was trading in this zone for a while, this zone. And then on NASDAQ, it broke through this level right here. And then it came back and back tested this breakout level, and then boom, off it went. So the question is whether S&P 500 is going to do something similar. So having broken this through this level, it is now back testing this level. If it's able to rebound and then move above this level, that confirms that this breakout is genuine. But if it falls back inside this zone, then obviously this would be a fake breakout. So the question is, S&P 500 traded in this zone for a long time, and the question was whether it would eventually break to the upside or break to the downside, and we know that it broke to the upside. So why did this happen? So let's look at the market narrative. So I talked about this narrative last week. There are two narratives in the market that is basically in conflict with one another. So this is the bullish case narrative, and then this is the bearish case narrative. Now, this week, actually, the bullish case narrative took control. The bearish narrative was primarily due to regional bank failure leading to credit crunch and eventually recession. But what happened is that over the last 8 weeks or so, what we are noticing is that stabilization in the banking sector. So it appears that the bank failures that started in mid-March is contained, and there is some expectation that it's not going to be widespread. In fact, several Fed speakers came out and said that they are not expecting any systemic problem in the financial sector. As a result, they think that interest rate can remain high for a longer period of time, and some are even suggesting that we might have Federal Reserve may increase interest rate at the next meeting. So effectively what that has done is that that has reassured the market that perhaps recession is not imminent. In fact, several of the Fed speakers said that recession is not a base case in their model. So as recessionary fears eased, the positive, bullish narrative basically took control, which is falling inflation. Federal Reserve is close to pausing. Labor market remains quite strong, which means that consumers are likely to spend money. First quarter earnings have been above expectation, and the bearish sentiment continues to be quite strong in the market. So let's have a look at the bearish sentiment very quickly. So this is the latest survey from AAII sentiment survey. You can see that the bullish sentiment fell from 29.4% to 22.9%, while bearish sentiment also fell, but the bearish sentiment remains well above the bullish sentiment. You can see that the bullish sentiment is, remains under 30%, whereas the bearish sentiment remains close to 40%. So this acts as a contrarian indicator. So as a result of easing fears of recession, what's happening is that the dominant factors, the dominant narratives took control of the market. And that's essentially what pushed S&P 500 out of this trading zone to the upside. So the question is, what happens going forward? What can we expect? Well, going forward, we still have to resolve this issue. So long as the banking failures, so long as the banking crisis remain under control, the next big issue is the debt ceiling. So we don't yet have a resolution to this issue between the Democrats and the Republicans, but the market for the time being feels that there will be some kind of a deal. Now, if that were to happen, then I think the bullish narrative basically remains under control until the next event, in which case I could easily see market moving higher over the next few weeks. I could easily see market moving higher. In fact, if you look at the sector performance this week, you'll notice that S&P 500 was pretty much being pushed up by the growth sectors like technology and communication. Now, these two sectors performed very well this week. We're going to see the chart. But what happened is that as recessionary fears eased, some of the more recession-sensitive sectors also participated in the rally. The discretionary sector, the financial sector, energy, industrials, building materials, they also participate in the rally. And that's why we got this big push to the upside in S&P 500. Now, if the debt ceiling, if we have a resolution to the debt ceiling, then I think over the next few weeks, some of these sectors which lagged has an opportunity to rally, like the discretionary, financials, healthcare. Healthcare was underperformer. Even staples, which have been lagging the last couple of weeks, I have a feeling that these sectors have an opportunity to participate in the rally and broaden this rally. Because one of the criticisms is that this rally has been the breadth has been poor. It's been led by a handful of mega cap stocks, which is true. But I think if we have resolution to this debt ceiling issue and the concern recessionary fears ease, then I think some of these cyclical sectors, more recession sensitive sectors can participate in the rally, which basically means that S&P 500 can gradually move higher. So what can we expect from S&P 500? So S&P 500 over the last few weeks has been trading in this zone. So this is 4,200 on the upside and around 4050 on the downside. If it breaks out of this range to the upside, a measured move of this distance would project a target to this level, which is basically where the August high is, which is what level is that? So that would be around 43.26. So that would be the level I would be targeting. So if I look at SPY, the equivalent levels are, so for SPY, the equivalent level would be around 431, 432 level, having traded in this zone. So if it breaks out and then there is price acceptance, gradually I would, that would be the price target. That would be the level to watch out for. Now, on a shorter time basis, as I said, this is very important. If we get price acceptance above this level, then that confirms this is this breakout is for real. Also, even if it pulls back underneath, as long as it stays above this level, which is 41.50, because this was the previous trading zone. So even if it pulls back to 41.50 and then does that, I think that's also reasonable, because that keeps the sequence of higher lows intact. So obviously this would be one level, the other level would be 41.60. Underneath this level, then obviously it invalidates a lot of the good work that has been done here. So those would be the two levels I would be watching. And then this level right here, if this gets taken out, which is 42.13, then there would be confirmation that this breakout is genuine. Now, looking at NASDAQ, first of all, let's look at NASDAQ on a weekly basis. So NASDAQ had another strong week. It was up almost 3.5%. And then this uptrend basically continues. This is a very strong looking chart, price action. Momentum indicators are very strong on a weekly basis. You can see RSI continues to move higher, and you can see MACD is rising well above the zero line. So there is nothing negative about this chart for NASDAQ or QQQ, whichever it is that you want to look at. It shows the same thing. If I look at the daily chart of NASDAQ, so here is NASDAQ. You can clearly see that NASDAQ this week has taken out this August high. So this is an important level. I mean, it didn't even stop right here, just broke through this level. Now what we want to see is we want to see price acceptance. If it finds price acceptance, that will confirm that this is a bullish breakout. But on the other hand, even if there is a pullback, I would expect the pullback should be met by buy demand and then eventually move higher, possibly to this level, which is around 14,000. This level is around 14,300 thereabouts. Now, I think this pullback and a rally is very much possible, only because it has gone up quite a bit. If you look at the hourly chart of NASDAQ, you'll see that short-term indicators are now quite stretched. You can see that so it had a big rally. So from 13,300 to 13,800. That's a big rally. So can it afford to pull back a little bit? Absolutely, because you can see that sequence of higher lows are in place. So if it pulls back and does that, I think that's quite reasonable without breaking, without making any technical break. I think it's entirely possible. So I would expect some kind of a pullback. I wouldn't be buying at these level. I mean, if you're already long at this level, then you can hold on to it. But if you're thinking of buying, then I would wait for a pullback, and then buy. But momentum remains very strong on a weekly basis, on a daily basis. So I would use any pullback as a buying opportunity. If we look at the other averages, so this is Russell 2000. So this is IWM. IWM has been one of the underperformers of the major averages. You can basically see that since this big decline, is it in the process of forming a double bottom right here? It's entirely possible, because I can see that the momentum indicators are gradually moving higher. You can see that RSI has moved above the zero line. So if RSI can stay above the zero line, RSI moved above the 50 level. If RSI can stay above 50 level, that would suggest to me that the odds would favor more to the upside. But it is still weak relative to S&P 500 and Nasdaq, but it is showing signs of improvement. So the first level would be this level. If it can take out this level, then I would target this level right here, which is around 183. But the first level to get through would be around 180. But it's beginning to look, I'm seeing some improvements. It hasn't given a full-blown buy signal, but I'm seeing some improvement, at least on a daily basis. The weekly pattern still, is not as strong. You can see that on a weekly basis, it's kind of stuck in this range right now. The momentum indicators is still weak. RSI is below the 50 level. So there is work to be done on a weekly basis, but I'm seeing some positive sign on a daily basis. What about Dow? So the Dow is also kind of weak. So you can see the Dow has been basically stuck in this range, only because financials, industrials, they make up a big chunk of Dow Industrials. And we know that financials, industrials, energy stocks haven't done very well. And then Dow is basically going sideways. So Dow needs to, break through this level first, which is around 33,000, say 800. If it breaks above 33,800, then that would be showing signs that it wants to go higher. But I think if, let's say, energy, if for example financials, energy, and industrials, these three sectors are important for Dow. If these three sectors participate in the rally, then I could see Dow moving higher. So let's have a look at the sectors. Let's see, what the sectors are telling us. So let's have a look at, we know that this is XLK technology. This is a very strong looking chart. There's no question. And it has been strong for quite some time. So, I would expect this to very much participate in the rally. Can it pull back a little bit? Sure. Some of these technology stocks like Apple, Microsoft, they're quite stretched. So I could easily see some kind of a consolidation, maybe pullback before making a move to the upside. If you look at XLC, this is another strong sector. You can see that series of higher lows. Can it pull back a little bit or consolidate? Absolutely. So if technology and communication, which have led the market higher, some other sector needs to basically take charge and provide leadership. And I think this is where maybe healthcare can come in. You can see the healthcare XLV hasn't done much over the last 6 weeks. It's been consolidating. It is oversold. Can we see an oversold bounce? I mean, it's very possible. If it can get through this level right here, which is around 132, then maybe it can move up towards 135. So this is one area I'm looking at for a rotation into maybe while growth sectors like XLK and XLC, they take a break for some time. Maybe the slack can be picked up by healthcare, because this is the second heaviest sector in S&P 500. Financial is another sector that I'm keeping an eye on. You can see that there is the price action is gradually improving since forming this low. You can see a higher low right here, and you can also see that it has, it's trying to take out this level. So you can see some improvement. I mean, it hasn't yet issued a full-blown buy signal, but I think if let's say we don't see any sort of widespread problem in the regional banking sector, then I think investors can gradually move back into the financial sector. So I could see the financial sector moving up a little bit. And then industrials, this is another important sector. It represents 9% of S&P 500. Now you can see that it has been trading in this range, and it's trying to break out of this range. So this is another sector which can provide a boost to S&P 500 as well as to Dow. So this sector, I'm watching this sector also because it is oversold and it is due for a bounce. Energy is another sector. Energy is small for S&P 500, making up 5% of S&P 500, but for Dow it's important. Now this sector is it's come under quite a bit of selling pressure. Can we see an oversold bounce? It's possible. So energy sector can rally a little bit. It's going to put upward pressure both on S&P 500 as well as to Dow. So this is another sector to keep an eye on. And then obviously you've got the utilities. This is not a big sector, but it is oversold. If we see a bounce in this sector, that's also going to put upward pressure. So what I think could happen is that if, let's say, we don't have any, if we have a resolution to this debt ceiling issue, I could see the rally broadening to these other sectors. So that should help out with the breadth. People have been talking about the breadth being weak, but I could easily see discretionary, financial, energy, industrials, materials, healthcare participate in the rally, maybe pick up some of the slacks from XLK and XLC. So that's so I'm overall positive at the moment on S&P 500 and the market, because I think this positive narrative has an opportunity to take control of the market for the next few weeks, and so long as we don't get any kind of unexpected reaction from the debt ceiling. Moving on to the other markets, so let's look at the bond yields. So I think it's interesting to see what's been happening to the bond yields. Bond yields have been moving higher. If you look at whether it's the 2-year or the 10-year, you can see that the bond yields have been moving higher on the 2-year, and on the 10-year you can also see yields moving higher. And in fact, on the 10-year, it has now broken through this range. So it had traded inside this range for a while. It has broken to the upside. Now you might say, why should the stocks rally when bond yields are moving higher? Well, that's because the reason bond yields have been moving higher is because of this, concerns about recession. You see, bond yields fell when the banking crisis started in mid-March. So let's have a look at this one. So this is mid-March. So when the banking crisis started, that's when the bond yields fell. And at that time, there was concern that a recession was imminent. It could start as early as the middle of this year. But over the last 8 weeks, what's been happening is that the regional bank crisis has been contained. And there is now some expectation that it's not going to spread. As a result, the recessionary fears have been eased. So the timeline for recession has been pushed out from, say, towards the middle of this year towards the latter part of this year. And as a result, what's happening is that yields are now moving up closer to the Fed funds rate. If you look at the Fed funds futures, you'll see that they are now getting closer to the Fed funds futures. So this is the Fed funds rate for June. So it closed at 5.1, which is still below the 5.25 Fed funds rate, but it was 25 basis points below the Fed funds rate. So it's gotten closer to the Fed funds rate. If you look at the the September Fed funds futures for September, that is at 5.1. It was well below 5% because it was expecting recession to be sooner rather than later, and as a result, it was expecting Federal Reserve to cut interest rate. But now that the recessionary fears have eased, what we're seeing is that yields are moving higher across the yield curve. So I don't think that is, so this yield moving up is not the same as when yields were moving up, let's say, during this phase, right here. See, here, yields were moving higher because of inflationary concern, because there was concern that the Federal Reserve would still have to tighten. I remember when yields were at this level, market was expecting Federal Reserve to pause somewhere around 6%, 5.75 to 6%. Then this happened, and now the expectation is that, and with inflation coming down, expectation is that yields doesn't have to go up to 6%. In fact, now the expectation is that Federal Reserve is going to pause. In fact, market is now, there is 82% probability that the Federal Reserve will keep interest rate unchanged at the next meeting. Obviously, that is subject to change, because before that meeting, we're still going to get a couple of economic reports, like the next month's non-farm payroll report and the CPI report, and that may change the probability. But as of today, there is 82% probability that the Federal Reserve will leave interest rate unchanged. So interest rate going up is because fears of recession is easing, which is not the same thing as inflation is on the rise. Not the same thing here, when inflation was still the primary concern. But now inflation is not, because we know that inflation has been falling. CPI has a 4 handle, and economists expect that by the end of this year, CPI will have a 3 handle. I'll just quickly show you. So here it is. Here is the CPI from 9.1% to 4.9%, and expectation is this is going to continue to fall. So if this continues to fall, then Federal Reserve doesn't have to be that much more aggressive. They can sort of pause either right now, or maybe they increase another 25 basis point and pause at 5.5. So the market is now beginning to feel that Federal Reserve is coming towards the end of its cycle. See, the market is, the economy is still holding up at when interest rate is at 5.25%. So if that's the case, the labor market is still strong when interest rate is at 5.25%. So if the Federal Reserve pauses here, then maybe the labor market doesn't have to crash and burn. And if the labor market doesn't crash, maybe we don't have a severe recession. And if we don't have a severe recession, then maybe we don't have hard landing. Maybe this is the outcome most likely to happen. And that's why the market is focusing, and that's why this narrative is controlling the market. And as a result, we're seeing S&P 500 major averages moving higher. So I'm not so worried about yields going up. I think this yield going up is only because there is less recessionary concern at the moment. But I'm not expecting yields to go up significantly more. Because the Fed funds futures are already close to the Fed funds rate. So if the Federal Reserve doesn't increase interest rate, next month, then I wouldn't expect Fed funds futures, them to go up that much more. With yields going up, so what we saw is that dollar has moved up. So the level to watch for dollar is this level right here, which is around 1.37, so I'm not sure that dollar is going to make a significant move to the upside. Even if it goes up, to me, this is more like a technical bounce, because dollar had declined quite a bit and it was oversold. So I can see, so this rebound has, pushed up some of the, released some of the oversold condition. So I'm not sure that we're going to get significant move to the upside on dollar. Strong dollar basically meant that gold initially fell. So you can clearly see gold is, So I think the goal is going to basically pretty much track dollar. If the dollar doesn't rise significantly, I'm not sure that this is going to fall significantly. I can see maybe a bit of choppiness and then maybe rebound again. So I'll leave it at that. Thank you very much for watching the video. If you're not, if you haven't subscribed to this channel, please consider subscribing, sharing, all that good stuff. Thank you very much.